Okay, are you ready? Well, we finally made it to arguably one of the most controversial topics in the whole financial services and planning industry, and that's talking about permanent life insurance. Some people swear by it, some people absolutely hate it. Well, today in part three of our life insurance video series, we'll talk about what permanent insurance is, how it works, the pros and the cons, and of course, why it sparks so many heated conversations. So, our mission with this channel is to really take you behind the scenes, give you information and a viewpoint that you're probably not finding within YouTube or on online when you're just doing a random Google search. We're going to tell you what we're hearing from clients and what we've heard from over the years in terms of the concerns and some of the things they say to us, as well as what we're hearing from like the different marketing channels and the people who actually sell these particular products and things like that. So with all of that being said, let's get into it. So let's define permanent life insurance. What is it? So permanent life insurance is a type of life insurance product that will provide you coverage for your entire life, as long as you keep paying the premiums for it. So if you remember from our last video where we talked about term insurance, that's basically designed to give you protection and coverage for a defined period of time. Permanent insurance, on the other hand, is basically the opposite. It's just like its name implies. It's meant to give you protection for your entire life and doesn't have an expiration date. Plus, it comes with something extra that all of the insurance agents and salespeople that are out there will love to talk about and really hype up, and that's the tax-free build up and ultimate withdrawal of cash value from a policy. So how does permanent insurance work? So keep in mind for this video, this is a very extensive topic and it has 4 product sets, which I'm going to talk about in a minute. So I'm going to keep this video at a very high level and not try to confuse you, and try to keep it very basic in terms of how to have just a rudimentary understanding of how these policies work. So when you buy one of these policies, you're paying an annual premium, and part of that premium goes to the cost of the insurance, and then the other part goes into the cash value account, which I mentioned before and we'll talk about further. This cash value again is going to grow tax deferred and ultimately come out tax free if you decide to withdraw it at any point in time. It's by far one of the biggest perks and or advantages of buying one of these policies, no matter which product you go with: whole life, variable, universal, or even index universal, which again, we'll get into in a minute. So over time, the cash value is going to grow, and you can actually borrow against the policy or even take out withdrawals, so you can use that cash for whatever you need, and then you can always repay the policy back if you'd like. And all of this comes without any tax implications as well, for the most part. Now again, there are 4 main types of permanent life insurance. You have whole life insurance, which is the oldest permanent life insurance product that's out there. You have what's called universal life insurance. You have variable universal life insurance, which is called VUL. And then you also have index universal life, which is commonly referred to as IUL. And by the way, universal life is referred to as UL. Now, to actually give you a visual of how these policies work, just so you can see, again, the very basics of it, let's just go back to our Life Insurance 101, which we looked at in the last video where we talked about term insurance. And let's just focus on the permanent insurance side of things. So again, as we were describing before, you fund the policy for a defined period of time. You can do it in a short duration where it's funded for, say, as little as 10 years, and then you can fund it all the way to age 100. Those premiums are, for the most part, again, depending on the product, are going to stay level over a period of time. As I mentioned before, as you're paying that premium, part of that premium is going to go to the cost of the insurance, which is ultimately going to buy you some death benefit. And theoretically, the death benefit, depending on the performance of the policy, is going to grow over time. So it might start out at, say, $500,000, but every single year you make that premium payment and the investment grows within the policy, the death benefit's going to go up. It's going to last you forever. So let's just say you died at age 85 and you funded the policy all the way through to where you were supposed to fund it to. The death benefit will get paid out to the beneficiaries tax-free. So that's similar. That's the same exact concept with term insurance, except term insurance, as we know, is going to expire after a period of time. So that's why this is called permanent insurance, where it's meant to cover you for your entire life. The other component is the cash value. So again, you funded the policy every single year. Part goes to the cost of the insurance, And then the other part of your premiums are going to go to the cash value component of the policy, which again, theoretically is going to grow over time. The cash value is going to grow again, tax deferred, and ultimately come out tax free in most cases. And you can use it for whatever you want. You can even go back, you can even borrow from it and then replace it. I've had clients do that. I've seen people use this policy in ways that will allow them to borrow from the policy because they got into a little bit of a jam. Maybe the stock market was down at a specific point in time. They didn't want to pull from maybe a down portfolio. So they pull from something like this. Now, again, that depends on which type of policy you have, if that really makes sense. But theoretically, that's really how it's supposed to work. Now, let's take it a step further to show you an actual example. So I'm showing you a whole life illustration here. I could show you variable and universal and index universal. However, I don't want this to get too crazy and all over the place. I just want to keep it basic. So the columns I'm showing you are the things that I just want you to key in on, not the actual values and how they grow, because those can all be altered depending on how the product is actually, what product you actually use or which policy you use, and how the product is structured and even funded. So a common thing you'll see is when you are in a situation where maybe you are working with an insurance agent or salesperson and this comes up, they're going to show you, a lot of times they'll come and they'll bring an illustration package, and it probably will have anywhere from 15 to 30 pages, and they'll go through it, and they'll then get to what you're seeing here on the screen, which is showing you the illustration ledger. And so you can see here, I mean, it can get kind of confusing by looking at it, but really, to keep it very basic and simple, you just want to look at 3 columns, in my opinion. And that is what the contract premium is, or the policy premium is, what the total cash value is here at the end of the year, as well as what your death benefit is. Now, depending on the products and how they work, because they're structured differently, and the values in the ultimate cash value and the death benefit are going to differ depending on which kind of policy you have. But if we look at an example like this, again, this is a whole life 65. If you bought a policy that's going to be a $1 million policy, it's going to cost you, say, $18,000 per year if we're using a 35-year-old male at best rates. And we'll talk about how the health classes work and all that stuff in the next video. But again, you fund the policy in year 1, you'll have only $1,590 of cash value at the end of year 1, and your death benefit would be about $1 million. Then if you go to year 2, you fund that $18,960 again. You can see the cash value went up to $3,579, and also your death benefit as well. And then if you look down here, you'll see again, you're going to fund it every single year, assuming that you can fund it. And then the cash value is going to start to really pick up steam. So you see it went from 3,500 basically to 20,000 to 38 to 58, and this grows. This is not a short-term type of policy, at least if you're looking at it from an investment perspective. Again, there's 2 ways to look at these policies. One could be from an investment and an allocation perspective, which has its time and place, and then the other can be from the permanent life insurance component. And you'll notice here that, again, as you're paying your premiums and assuming that the policy is actually growing, you're going to see that these values are going to start to increase. Now, again, it's going to be slow at first, but then it will pick up. It is a compounding tool. So as I was mentioning before, when we look at the different types of insurance, they work differently. And so that's going to affect those cash value columns and the death benefit columns that I was showing you before. So let's break it down for you just so, again, you can see the basics. So there's 4 main types of permanent life insurance. The first, let's talk about whole life insurance. So whole life insurance are going to require fixed premiums, but they're going to give you a guaranteed death benefit and guaranteed cash value that grows at a steady rate over time. These particular policies are really for people that want predictability and security because of the guarantees. The downside, just like with all permanent insurance for the most part, it's usually a lot more expensive than term insurance. Think anywhere from 5 times to 10 times, depending on the structure of the policy. The way that whole life insurance works is that the values within the policy, and why I was stressing that so much before, are going to grow based off of the insurance carrier that you buy the policy from. They're going to take your premium dollars and they're going to invest it, and then ultimately provide a return back to you, which is known as a dividend that's ultimately credited to you. And that dividend is going to ultimately buy you more death benefit, which is why the death benefit is going to increase every year. And also cash value, which is why the cash value is also going to grow every single year. Now, the cool thing about whole life insurance is that it does provide a guarantee. So generally speaking, anywhere from 2.5 to, maybe like 4% is what the guarantee, depending on the insurance carrier. But on top of that guarantee, you'll get what's called a variable dividend, which again is based off of the performance of the insurance carrier. Now, these dividends usually don't fluctuate much in a given year. They might go up 10, 15 basis points. They might stay even in a given year. They're very safe. They're very steady. They're not going to get you a 20% return. So don't ever really expect that. The way that most insurance salespeople will really market this to you is the fact that it's going to have some sort of like fixed income correlation, because at the end of the day, when you look at all of the mathematics behind it, it's got very similar returns to fixed income. Generally speaking, whole life insurance is typically best bought from a mutual carrier. So whether that's like Mass Mutual, Guardian, New York Life, Northwestern Mutual, Penn Mutual, those are typically the best carriers. A lot of the what's called stock companies don't really offer whole life insurance. They're going to offer the variable contracts as well, that are VUL and IUL specific. Now, one of the other forms of permanent life insurance is what's called universal life, or UL. This does provide some flexibility within the policy where you can adjust the premiums up or down. It's really not used for cash value purposes. It's really meant for long-term permanent death benefit and is usually priced accordingly as well. So it's not going to necessarily be as expensive as whole life insurance, but it's not going to be as inexpensive as term insurance. And the cash value is going to be very low because the way that these policies are, the way that they grow are based off of an interest crediting rate that is determined by the insurance carrier. Now, variable universal life, aka VUL, that's going to be kind of like the polar opposite to whole life insurance. So same theoretical premise. You fund the policy. However, those dollars that go in that secure that permanent death benefit are going to actually be then invested in what's called sub-accounts, which are basically provided by the insurance carrier. Now, these sub-accounts are basically, you can think of it as when you have a 401k at work, you're provided the ability to select, I don't know, maybe 10 to 20 different funds. You'll have a fairly large list of different funds that you can invest in. Now, they're not going to be typically, at least the ones that I've seen, aren't going to be funds that you generally can go out and buy a specific ETF or mutual fund. They're going to be very proprietary focused in terms of different managers that are out there. So I always found it to be a little bit hard to research, which funds could be best. They're very general in nature, but it allows you to go out and be able to invest within the stock market and get stock market type returns. That could be a good thing or it could be a bad thing. There are no guarantees when you're speaking at a base level with variable universal life insurance. So the values of the policy are going to grow and or decline in relation to how well your investments do. So the values of the death benefit and the cash value are going to go up and down over time based off of the performance of the investment choices that you make. Now, variable universal life also tends to cost less than whole life insurance, but again, it's still going to be, call it 5 times more, if not higher, than term life insurance. So with an IUL or an index universal life product, you can invest in the stock market and in different funds. The difference is that there's going to be a high point, like a ceiling, and then you're going to also have a floor where it can't go below a certain amount. So there is some sort of guaranteed component built into it. So in summary, that's how the permanent insurance product landscape works in terms of how these products are designed. Whole life is all about guarantees, crediting a dividend to the policyholder. It's got a guaranteed rate of growth that you're going to get in a given year, plus whatever you get on top of that. It's going to be somewhere like 4 to 5% that you're going to get within that particular policy, not early on, but typically later on. Whereas opposed to the variable universal life and the IUL, which is going to have the ability to grow substantially. However, you're going to have some risk because of market exposure and things like that. So you have to be careful. You have to actively manage those particular policies and just look at it at least on a yearly basis just to make sure you're in good standing and you're not 30 years down the line and you get some sort of big surprise because the policy hasn't performed as well as maybe what it was illustrated when it was initially sold to you. You really just have to decide which one is the best structure for you and which is the best design. So just to kind of like recap everything at a high level, pros of permanent life insurance are really simple. It's the fact that you'll be able to get lifelong coverage, unlike term insurance, which ultimately will expire. You're also building equity or quote unquote equity within the policy through the cash value. And that's going to grow tax deferred and come out tax free in all of the structures that I was speaking about. I think one of the most underutilized aspects of how these products are sold, and I think this is a really important part of this, is the fact that, again, it's a life insurance product. So most agents and salespeople that are out there are selling it from an investment perspective and sort of placating off of that, either the guarantees or, this, that, and the other thing. But keep in mind, one of the biggest benefits is the fact that it's permanent life insurance. And that's very hard for sometimes people to see when they're going through the initial life insurance planning process. They're thinking about, and in a lot of situations, it's a young family. They just had a kid. They have a lot of liabilities. Maybe they just bought a house, whatever the case may be. And their earnings maybe aren't at the point to where they think it might be in the future. And so, when you see the cost of, say, term insurance, which can be very inexpensive to what permanent insurance is, a lot of times people just automatically say, you know what, I'm just going to go with term insurance. But I definitely would suggest thinking about the long-term aspect of things and the fact that at some point in time, that permanent insurance is going to go away, because the policy is going to ultimately expire. So having some piece of permanent insurance could be very beneficial when you get out into your 50s or early 60s, because you might get to a point where you might say, you know what, I've done well and but I still need to have some insurance in place. Plus, maybe there's some health issues that come up that preclude you from maybe going out and buying term insurance or some sort of life insurance product when you're in your 50s. Another major component that I don't hear people talk about a lot online, and that's the fact that as of like 2018, I think it's like 2017 or 18, you can now add a long-term care rider on your permanent insurance policies. So that is a huge thing that was developed and incorporated by the insurance carriers just because of the whole nature of the long-term care market and how they were selling individual policies. It's a long story I won't get into, but the fact that you can now, as a younger person, go out and buy a permanent insurance policy and pay a very small amount to add on the long-term care rider, which then will give you the ability when you get out into your 60s, 70s, or 80s, the ability to access up to, I think it's like, it depends on the policy, but 90% of your death benefit for long-term care needs. So no matter what, you're going to be using the policy at some point in time, whether it's the cash value, whether it's the death benefit for your heirs, or maybe even the long-term care, because long-term care is very expensive. And people that have gone through it understand it, like when they've seen a parent go through it or a grandparent. So that's a really key component to understand how these policies work and how they can be beneficial. So yes, that life insurance salesperson is going to come in and they're going to talk about asset allocation and this product performs this and that. And why do you want to be subject to market volatility with your investments and this, that, and the other thing? And that's all well and good. And there's definitely some people who love the guarantees and they love the fact that it's tax-free, because there's just not many tax-free vehicles that you can use that are out there. But when you step away from that, because that's not really the main purpose of life insurance in and of itself, and you look at the permanent life insurance for the long haul and the possibility of adding on long-term care to not push that onto maybe your kids or other family members or deplete from your assets that you're ultimately going to pass on, is a big thing. Now, the cons of permanent life insurance are really as follows. It's going to be it's more expensive to buy it. No matter which product you buy, it's going to be more expensive. So you just have to be sort of aware of that. And also, there's a lot of moving parts with how these policies work. I mean, I showed you the illustration before in all of the columns. It's going to be also very hard for you to figure out how much it costs, how it works. It's just not an easy thing to understand unless you really sit down and study it. Number one, with whole life insurance, you'll never figure it out. It's kind of a secret formula that they have. They'll give you some clues. It's kind of like If you were trying to get to the top of search engines, Google's not going to tell you exactly how to do that. They'll drop some clues and you kind of have to figure it out yourself. With variable and index, a little bit more, it's definitely more, you can kind of figure it out better, and it's clearer in terms of where everything is coming from, but it can be complicated, and you don't want to go into these policies lightly because they do have surrender periods. Also, sometimes you'll hear a lot, like from the Dave Ramseys of the world, basically buy term and invest the difference. And I'm not saying listen, I think what happens a lot of times in the space is that these products, they get oversold by the insurance salesman. They do have bigger commissions. The percentage is actually the same, no matter if you're selling term or permanent insurance. It's just the premiums are a lot higher, so you're going to get paid better. So think of it from that perspective when you're sitting across the table from somebody of, do they really have your best interest in mind when they're talking to you about how these products work and if it's right for you. But whether or not buying term and investing the difference is the better thing, you got to think of it from the life insurance protection perspective of it, is making sure that you have the right amount of death benefit in place and going through that formula and process that we talked about in the first video, and making sure that aligns within your budget and that you're not overdoing it. Because the way that it's marketed and sold, it can look very attractive. Yes, you have all of the tax plays and everything like that, but not everyone needs permanent life insurance. So keep that in mind as well. And as I was saying in one of the other videos, you have to be cognizant of who's actually selling you the particular policy. Is it an independent agent, or is it a captive agent, or is it a financial advisor who's really just more or less gathering assets and is relying on some other group to come in and talk to you about it? They're going to have more of an independent feel than anything else. But again, if you're talking to somebody who is aligned with a company that only sells variable or index universal life, that's what they're going to focus on because that's what they could sell. And that doesn't mean that it's necessarily the best for you. Whereas opposed to if you're speaking to somebody from maybe a mutual company, that they're going to focus on whole life insurance. So just understand that there are options out there for you, and investigate them and make sure that you have everything that you need. We're an independent firm, so we can work with whoever we want. It doesn't really matter. We're just trying to find out what the client actually needs and then find the best fit, whether or not it's whole, universal, VUL, or IUL, or even term. So one of the last things, again, that I'm going to leave you with, I'm sure I forgot something. This is a very heated topic, and you will hear people. I was just on the phone with someone the other day, and they said, I've heard, permanent insurance, it's a scam or it's a ripoff. So there's a lot of stuff out there. It's very similar to annuities or ETFs versus mutual funds or active versus passive. Those are like to me, at least, that's what we find to be like the big hot topics in the industry in terms of where people have like really strong opinions and strong debates. And I'm not saying I'm not on one side or the other. We think everything is situational. It depends on the client's situation. But you're going to find people out there and a lot of stuff that's written that is, in one camp or the other, and very much on one side or the other. And it's true, it does get missold. And there are people that should not be buying permanent insurance that are kind of sold into it. And there are people out there who just, once they hear life insurance and investments, they automatically just turn off. And that's okay too. But that does happen. But just try to look at it from an open perspective, one way or another. Again, one way is not better than the other. You have to just decide what's best and trust the person that you're working with, or trust yourself when you're going out to market to buy this. So I hope all this helps. If you like this video, definitely give a thumbs up because that helps us really grow this channel. If you need anything, feel free to reach out to us via email. You can find that on our website at sanderssmith.com. And we're always happy to help. And we'll see you in the next one. If you're ready to take your financial planning to the next level with a customized approach, feel free to reach out to us. This way we can help determine if we can even help you or even point you in the right direction. The best way to reach out to us is through our website at sanderssmith.com. Thanks for watching. For more valuable tips on financial planning, check out those videos here. And if you found this information helpful, please like and subscribe so you don't miss any future content.